Hello, and welcome to FIS Group's Market Outlook for the first quarter of 2017. We'll recap 2016 and look at our big picture overview for 2017. Then we'll take a closer look at some of the themes we believe will drive global markets for the first quarter and beyond. 2016 was not a good year for those in the prediction business. No major election played out the way the pundits had called it, and then the markets largely shrugged off the anticipated dire effects of each one. Global equity markets turned in healthy combined gains despite the experts' warnings that the sky was falling. We think it's unlikely that 2017 will bring any relief from the policy and market uncertainty that ruled the day in 2016. We've borrowed and adapted our title from former Secretary of Defense Donald Rumsfeld's initial assessment of the risks of a U.S. invasion of Iraq, which, like many of 2016's sure things, missed the mark due to overconfidence in what everyone thought they knew. For example, we believe that the current equity rally and the underlying theories that support it have some cracks that leave them vulnerable to a similar fate, where the past comes back to bite those who overlook the warning signs. We'll be looking through the lens of what we are calling underappreciated knowns in a broad range of areas. This year, investors will be waiting to see if France, Germany, and the Netherlands follow the wave of populism seen in 2016. In the U.S., the new president defaults to unpredictability, and in China, the struggle to maintain labor stability will likely be complicated by the new U.S. administration's criticisms and intended actions. Right now, the primary risk to the recent rally in global equities is that they are overbought, especially among U.S. equities. In particular, we believe that long-term expectations for U.S. earnings growth are unreasonably lofty. Unease about China could also spook markets. Next, we'll look at what we believe is the single biggest risk for 2017. The U.S. dollar enters 2017 up by 25% against a broad basket of currencies over the last 2.5 years. A continued bull run by the dollar could be destabilizing in many ways, including pressuring U.S. manufacturers, widening trade imbalances, and hurting emerging markets' debt and equities alike. We believe the dollar is due for consolidation in the short term, but will end 2017 higher. Now that we've looked at the big picture, let's turn to our known knowns. Both U.S. and non-U.S. equities are discounting a significant pickup in growth and earnings. There are 9 key points supporting the bullish consequences on U.S. equities. First, continued improvement in corporate earnings driven by stabilizing prices for oil and other commodities. Second, growth in real wages and income. Third, inflation rising, though unevenly, fueled by a strong dollar. Fourth, higher interest rates at the long end of the yield curve, which will trigger an end to 35 years of a bull bond market, coupled with, fifth, mildly higher interest rates at the short end of the yield curve thanks to interest rate hikes by the Fed. Sixth, acceleration in GDP growth. Seventh, fiscal expansion as President Trump pushes for tax cuts, bringing profits home from offshore havens and higher defense and infrastructure spending. Eighth, a relaxed regulatory environment, especially in the financial, healthcare, coal, and oil industries. And finally, ninth, is the possible protectionist moves that will put smaller companies and those focused in the U.S. at an advantage. Meanwhile, equity markets outside of the U.S. also gained, but more moderately, turning in a 4.5% combined return in 2016. Valuations aren't quite as high as for U.S. equities, but are still steep. 4 factors make up the foundation of consensus outlook for non-U.S. markets. 1. Policy divergence from the U.S. as both the European Central Bank and Japan continue to pursue accommodative monetary policy. 2. Better news on industrial production and positive economic surveys in Europe and Japan. 3. European and Japanese companies have more operating leverage and more attractive valuations to boost price-to-earnings expansion. 4. In Beijing, policies continue to support growth and labor stability. Looking beyond consensus, we consider what some of the more underappreciated knowns might be. First, the positive sentiments we've already outlined may be priced into markets now. The longer the uptrend in stocks continues without interruption, the greater the risk of a pullback if growth falls short. Small-cap stocks may be especially vulnerable to overly optimistic expectations. Among non-U.S. markets, there is little room for error for emerging markets. Emerging markets equities have benefited from a lot of good buzz as investors pin high hopes on China's desire for growth and stability in the run-up to the Communist Party Congress this fall, a pickup in global growth, and improved fiscal and trade balances. However, Chinese monetary policy has actually been relatively restrictive, and it turns out that trade balances have had less impact than fundamentals for emerging markets companies. Finally, there are several geopolitical risks that may fall into the category of underappreciated knowns, or even unknown unknowns in terms of being more difficult to quantify and less likely to progress in a linear way. Thank you for viewing this presentation. For more on this market outlook and to see our full global and sector positioning for the first quarter, please visit our website at fisgroup.com or contact us for further information.